Welcome and thank you for joining us today for our lunch presentation of the benefits of voluntary disclosure for state and local taxes. If you're selling products or providing services in multiple US states, you may be creating potential state and local tax liabilities. You may not even know that you're doing it. So the question then becomes, now what do I do? If you think you might have potential exposure. So Tom is going to walk us through this today, give us some suggestions on what to do next, recommendations on how to address prior state tax liabilities, and how to avoid future issues. I'm Carolyn Powell. I'm the Development Director here at Tronconi Seguer & Associates. I am going to be your host today. And again, if somebody could let me know in the Q&A if you can hear and see me right now, that'd be great. On the right-hand side of your screen today, there is some tools for you and ways that you can engage. There is a question section. If you have a question throughout the presentation, feel free to type it in there and Tom will answer it at the end. Also, too, in the handout section is a copy of today's presentation and Tom's bio. If you'd like to download those and take notes as we go, it's up to you, and that's in handouts. And then lastly, after our webinar today, you will get a survey. I ask if you could just take a minute and fill that out to let us know how the presentation was. If you have any additional questions, you can put it in there. If you'd like to set up a time to talk with Tom one-on-one or any of our other in-house experts on a tax issue or an accounting or audit issue, you can do that in our survey. So feel free to just take a minute and do that for us. That'd be great. So without further ado, we're going to get started. Just real quickly, Tronconi Seguer & Associates, we're a certified public accounting and business consulting firm. Tom is our expert, and he is a CPA with over 20 years experience in public accounting. He has a broad range of industries that he works with: manufacturing, food, financial services, software, environmental remediation, and electronic commerce. So he's got a lot of background in this and definitely can help you with the questions that you have. And I'm sure he's already dealt with some of these issues with somebody similar to you. So I'm going to turn it over to Tom and have him get started.
Thanks, Carolyn. Good afternoon, everyone. Thank you for joining us today for this SALT webinar. It's another snowy, cold day here in Buffalo, and hopefully we're turning the corner on that in the next week or so and got to get into spring as we near St. Patrick's Day this weekend. What I wanted to do is kind of to give a quick introduction of how do we get here with voluntary disclosure. I mean, before we talk about what it is and how it works, I want to take a step back and discuss, the how and why do businesses get to the point where they need to consider something like voluntary disclosure for their state and local tax compliance. And, we're going to talk mostly about clients or companies or taxpayers who, sell in various states, but, you could just be a company in New York, for example, who didn't realize that I didn't realize I need to register and collect tax, or everything I sell is exempt. And why do I need to register? And, there are cases where, we do one-off voluntary disclosures and help companies come into compliance, and it's just here in New York or just in one other state. But generally what happens in this is that taxpayers regularly need to evaluate and look at their sales and their business activities in different states. We suggest, you do that on a quarterly basis, at the very least annually. Ever since 2018's Wayfair decision, where we now have economic nexus thresholds for sales tax, it's no longer physical presence or nothing. We want to look at our sales and see whether or not we're tripping these thresholds on a pretty regular basis. You don't want to wait too long and then have, 12 months, 18 months, or even more potential prior liability, after you create a nexus in a state. You also need to evaluate, are my sales taxable? Am I selling tangible personal property in a state that is subject to sales tax? It makes a big difference. If all you do is sell to distributors for resale, I might say, you know what, don't bother with doing anything like a BDA or even registering, as long as you're, complying with collecting your resale certificates. And then also, it's not just a sales tax matter, but income tax or even withholding tax. Do we have physical presence in the state? Do we have boots on the ground? And is it more than just salespersons? Do we have, especially these days, telecommuting workers who are working from, a home office in a state? I mean, that's potentially creating nexus for sales tax, income tax, withholding taxes. And, we need to identify this and catch up on it. Because, what happens is in these states that, if you create nexus, you have the potential filing requirements and there's potential tax liabilities for prior periods if you don't catch this or handle it on a regular basis. So we see this all the time, right? And there's really three options that we really see. One, do nothing. Pretend it doesn't exist. Ignore it.
Hopefully we don't do that.
Well, yeah, sometimes clients do that, and sometimes it's okay, depending on whether or not there's really any liability. I wouldn't suggest that if there is. The second option is, well, okay, we did a nexus study, we see we're over some Wayfair thresholds, we're just going to register and start filing sales tax returns on April 1st, 2023. We're going to ignore the fact that we may have created nexus in 2021. It's fine. I've done it before for clients. What do you got to do? It's better than nothing. But at the same time, there are issues with that. You're not providing maybe the correct information on your registration form when the state asks you when you started doing business there. If you really read the fine print on the registrations, you could be committing perjury by doing that and subject to additional penalties and prosecution by a state for that. But it happens all the time. And in most cases, I'd say you're probably going to end up okay. The problem is with Wayfair being passed in 2018 and all these economic nexus thresholds created from July of 2018 all the way through January 1st of this year with Missouri, the states are starting to look. The states are starting to audit companies. They're sending nexus questionnaires to people who registered saying, hey, thanks, we really appreciate that you registered as of April 1st, but can you do us a favor and can you tell us what your sales were the last 3 years? Because they want to see if you were over any of their economic nexus thresholds. They might send you a nexus questionnaire or something to fill out. And that's when you can get really jammed up, because at that point, you can't do a voluntary disclosure. They got you. And they got you for as long as they think they can get you for interest, for penalties, and everything else that goes with it. So the third option that we talk about is working with the state to address your prior liabilities using this voluntary disclosure process or voluntary disclosure agreement, VDA for short, we call it. And it's a really good option for a lot of companies, to correct their prior mistakes or prior liabilities. Simply put, the most basic definition, it's a process of voluntarily reporting unpaid or underpaid tax liabilities to a state tax authority. And you might be saying, Tom, that's crazy. Why would I come forward and tell the state? But, you are going to get something in return for this. If you can see on the next slide here, in most cases, a state, in exchange for your payment of tax and interest, and for, your agreement to comply with their tax laws and be a good taxpayer in the future, they're going to offer you some benefits. There's going to be a limited look back period for voluntary disclosure. They're going to limit this to 3 or 4 years of look back, depending on the state and their statute of limitations. They won't go back further. I mean, most states, if they audit you and you're an unregistered taxpayer, they'll go back 6, 7, 8 years. I mean, they can go back forever if you've never filed a return. But really these days, especially since Wayfair passed in 2018, we're at that 4-year mark, almost coming up on 5 years since Wayfair passed. So you have a lot of states that have 3, 4 years of statute coming right now. So you want to get in and take care of this before it gets too far back, if that's an issue. They're also going to waive your late filing or late payment penalties, which add up very quickly in some states. Most states will not abate or waive interest. You're going to pay interest for filing and paying that tax late. So there's a few out there who might lower it or waive it at a specific time period, but for the most part, you're stuck on the interest. There's a confidentiality provision in these agreements where the states aren't going to go blab to their friends, next door in Pennsylvania or Ohio and say, hey, we got these guys here that just filed tax returns, they were late, maybe check if they were late in your state too, they're not registered. So there's some confidentiality. You're going to avoid any criminal prosecution if cases where maybe you collected sales tax but didn't remit it. For most cases, most voluntary disclosures will get you out of that as well. And I think the biggest deal is you're now fully in compliance with the state tax laws. You don't have to worry or look over your shoulder as to, hey, I just registered April 1st, but I know I got some prior liability. You're not sweating out a notice or a questionnaire or waiting for the statute of limitations to expire. You're in full compliance. And, unfortunately, for sales and use tax, it may cost you, right? Because you're going to likely be coming out of pocket for a sales and use tax voluntary disclosure. You're going to be remitting tax that should have been paid by someone else. Sales tax is really just a pass-through. You collect it and remit it. Someone else is paying it. When you get into this point where you're doing the voluntary disclosure or an audit or something, you're paying someone else's tax, which is the greatest sin there can be, I think. But it happens, and sometimes depending on your business, if you're an online retailer who has 2,000, 3,000 transactions a month with end-use customers, you're not going to go to them for that money back. You're not getting it. But maybe you're a type of business with just a few customers, large dollar sales. You might be able to work with them to get that money, that sales tax back. Or what we always do in these cases is we go to these customers and we send them what we call an XYZ letter and ask them, were you audited for this period? Did you remit use tax during this period on our purchases? You never know what you're going to find that might reduce your liability a bit. But we're talking about this voluntary disclosure. So who's eligible? What taxpayers are eligible? Typically, you're good to go. Anyone's really good to go unless the big thing is you've been previously contacted by a state tax authority. So what does that mean? That means they sent you a nexus questionnaire 2 years ago. They sent you some kind of notice about compliance. They may have given you a call that you didn't respond to. Sent you some kind of bill. Anything like that could preclude you from taking part of voluntary disclosure because they obviously know who you are. They have your name, your address, and when they enter you into the system to do a VDA, it's got a cross-reference whether you've been contacted before. So you need to be very careful about that if you're thinking about it. Did you file any nexus questionnaires or notices in the old circular file 3 years ago? You're going to want to know that before you try to do a VDA with that state. If you previously registered or filed returns for sales tax, let's say, and then you ended your license, you closed out your license or permit for whatever reason, and now here you are again back in it looking to do a VDA for that tax, they're probably going to preclude you because they're going to ask, why did you ever close your permit in the first place? Maybe you should never have done that. And then obviously, if you've been audited or you had gotten an audit notice or there's some type of criminal investigation against you in a state, you're not going to be able to avail yourself of the VDA at that point. It's too late. The other thing too, I've got here, if you previously collected sales tax but didn't remit it, that's always been a huge no-no in the state and local tax world because it's a trust fund tax. Someone else paid it. You're just remitting it. A lot of states consider that a felony. In a lot of states in the past, it was very hard to do a voluntary disclosure if that were the case. I would say since maybe the mid-2010s, 2015, a lot of states have loosened on that. I think the internet commerce has had a lot to do with it, actually, because I'll be honest with you, and I've seen it before for clients, there's times where you may start collecting tax. You're on Shopify or you're on some other system collecting tax on your internet sales or your other sales, and you hit a button and you're collecting tax in that state, and you may not even realize it. So I think the states have come to grips with that and understand that, hey, look, there's a lot going on for some of these companies. If you can provide a decent explanation or what are some extenuating circumstances related to why you collected tax but didn't remit it, they're still going to let you handle or do a voluntary disclosure. It definitely has to be handled delicately. You definitely want to disclose this up front. Like if I was handling the voluntary disclosure, I would call the Nexus unit or Discovery unit or whoever I'm dealing with and talk to them beforehand and kind of get a feel for what's the issue here? What do you guys need? How many years? What am I going to hit with interest and penalty wise for not remitting? Most states are willing to work with you though. It's not, the arcane dark ages like it used to be when it comes to this. So what is the process? How do we do this voluntary disclosure agreement, voluntary disclosure process we've been talking about? And typically, it starts with preparing some kind of written offer or request letter. These days, we're seeing a lot of states have online application forms that you go to their website and submit to start the process. And, these can be filed in, I'd say less states than it used to be, but still about half the states, if not more, on an anonymous basis, which is nice because you don't want to disclose your identity at first, especially if there's a chance the state may not accept your terms or, there may be issues here. You don't want to give up your identity right away and let them know who you are. You can negotiate anonymously. Most times it's through a third-party representative, whether it's a CPA or a consultant or an attorney who has some, experience doing this. They act on your behalf. And, you can negotiate some terms, whether it's a look-back period or penalties, interest, how the tax is going to be remitted. I kind of say that whimsically because we all like to say we can negotiate the terms, but in all honesty, these days, these programs are pretty strict regarding what you're going to do, how you're going to do it, and the time period. There's there's really not so much room to negotiate anymore with these state tax authorities. The nice thing though too with this, and I have found this to be very helpful, is the people you're dealing with, and whether it's a nexus unit or a discovery unit or some kind of special compliance unit that handles voluntary disclosures, very knowledgeable folks. You know, they understand the issues, they understand the tax law very well, and they're very good about working with you. I mean, there's guys I've worked with, guys and gals I've worked with over the years in these units, I'll still go back to. Or if I'm having an issue with that state, I'll call them and see who they think I should call. Washington, I can think of, for example, great voluntary disclosure unit. I mean, the guys there are really good at what they do, and they're willing to work with you. So you're not just getting, the person who answers the 800 number here when you call for some tax information. You're getting some very specialized people who are good to work with. So typically when you're writing this letter or you're providing, you're like, Tom, what information do I need to provide here? And, for the most part, I kind of went through some of the state websites, and, you're going to provide the type of entity, you're going to provide a brief description of your business activities in that state, whether or not you have people in the state, you're selling through somebody, you're providing services, you're just selling tangible property. You got to give them some kind of description of that. You're going to provide the date you began doing business as well as the date you began doing business in that state. They're going to want to know the tax types you're disclosing or type. We'll talk about that in a little bit too, tax types, what I mean by that. You might already be registered in the state for certain taxes. That typically does not preclude you from doing the voluntary disclosure. If you're remitting withholding tax for employees in that state, or you're filing income tax returns, you can still do a VDA for a sales tax. They're going to want you to disclose if you've had any prior tax. Again, that's usually a big no-no, red flag for moving forward with this. You're going to want to estimate your tax liability, which at this point you're going to hopefully know you've had nexus, how long you've had nexus, what products and services you're selling are subject to tax in that state, so you can give them a roundabout liability calculation. And then, like I said, some states may ask you to complete a nexus questionnaire at some point, that they just want to ask all the different questions to see if they can get you for more than just the tax you're disclosing. Could you possibly have an income tax liability in addition to the sales tax one that you're doing a VDA for? And then, sometimes there's other additional information that they're going to want. So that's typically the information you're going to provide. So you're going to send this letter, you're going to do this application online, and hopefully within a couple of weeks, you get a response from the state. I say a couple of weeks. New York, most likely a couple of months. California, you're lucky if it's a couple of years sometimes. So they're very behind. But what happens then, and you might get some correspondence, or you might get an email or call from somebody who works there, maybe to clarify some facts or representations you made, or just ask a couple questions. And that's great. And at least they're working on it. I always want to be honest and, and as truthful as possible when you're talking to these folks about the issues. But at some point, you're going to get a voluntary disclosure agreement in the mail or email. And typically, they're going to want that signed and returned within like 30 days or whatnot, to kind of confirm the fact that we are doing this and that you agree to the terms and conditions. Then once you sign it, the state will sign it and send you an executed copy back. So that voluntary disclosure agreement's got to outline all the terms and conditions that they're offering, what the look back period is, what they're waiving interest penalty, how they expect you to file returns for sales tax or income tax, and what they expect the future is going to be, and what's going to happen if you don't live up to your side of the bargain here. And you need to really, really review this carefully. I mean, this is where you want, a CPA, you want an attorney to review all the terms and conditions, because this is a binding legal document. And if you misrepresented any of the facts, if you do not live up to your end in the future, they can go back and basically waive everything and say, you know what, the agreement's void. We expect tax, interest, and penalties now on all these prior periods, and they might even say, we're going back even further. So you really need to look at the terms and conditions. I don't want to scare anybody here, but you definitely need somebody with some experience and expertise in this area to review it. The states aren't going to try to gotcha, on this, but you need to know what you're signing and agreeing to here. Because when you are signing, if you've done this anonymously to this point, this is when you're disclosing who you are, you're providing your FEIN, your address, and whatnot. So definitely want to read this closely. And then in addition to, you have maybe 30 days to respond to that, they're going to say, okay, taxpayer, you now have another 30 days or 60 days to do the rest of this stuff, to prepare and submit your tax registration application, because you have to go through their system, typically online, fill in the blanks, because you're gonna have to, for sales tax, file returns going forward, or income tax, and they're gonna want all your information in that system, because the state has different systems. There's the registration, there's audit, so they're gonna need to do that. This is then, you're also gonna, calculate your tax liability. For income tax or franchise tax, gross receipts, you just got to file your returns for whatever periods. For sales tax, you might get lucky and actually have a state that allows you just to submit spreadsheets in lieu of returns. This way, you just basically calculate all your sales, lay out your sales as detailed as possible in an Excel schedule. Here's what my taxable sales are, the tax rate, due. It's a lot easier than filing returns on a quarterly or monthly basis going back 3 years. That could be a real hassle to do. And unfortunately, there's a lot of states who require returns these days, which is a shame. Then after you do all that, you're going to send them a check, you're going to pay online, you're going to pay your tax and your interest, and they're going to agree to waive the penalties. You're going to provide any additional information to the state that they ask for. At some point, you're going to probably send a power of attorney in, for your representative. Maybe there's some additional questionnaires or authorizations they're going to need. You'll do that there as well. And typically, you've got 60 to 90 days once you get this agreement from the state to complete all this. And they're willing to work with you too. I mean, we've extended it here and there if we've had to, and it's not really been an issue. Again, I want to reiterate the fact that, the state is typically reserving the right in the agreement to audit the facts represented as part of the BDA. So they can audit your fact pattern. They can audit any of the returns you filed for the look back period. They're basically going to agree to not go beyond the look back period, but they can audit you for that period if they so choose to. New York used to be pretty good about that you would do a BDA and you could expect an audit notice, and they were coming out to validate and verify everything. Not so much lately have we seen that, but it used to be totally the case. And actually, like I said before, they can also void the agreement if there are factual misrepresentations or if the taxpayer fails to comply with the terms. So again, you need to be very careful about that and understand what you're signing on for. So I wanted to give you a couple examples with just some of the basic terms and conditions from a few different states. So you can see kind of how different or similar that they can be. This slide, I've got pretty much, I got the big three, California, New York, and Texas. I mean, you can see California and New York, their look back period is about 3 years each, 36 months, while Texas will go 4 years, but Texas will also waive interest as well as penalties. New York and California won't do that. And interestingly enough, too, I mean, look at the application, how different this is. We've got California who wants you to register essentially and then mail a form, like mail a form in. New York has an online application, and then Texas says, well, write something up and email us. So
Wow, could it all be different?
yeah, well, that's state and local tax, Carolyn. I mean, it's 50 different countries, and they all have their own rules. And you can see when it comes to being anonymous, California and New York, well, no, because you're filling out a form, you're filling out an application. Texas is like, I mean, literally, that's kind of how it reads on their website. Like, you can be anonymous if you want to, like, we don't care, like, whatever you want to do, whatever makes you comfortable. And then the timing, California, honestly, I have no clue. I mean, how long, they give you, they can't even really predict, read into anything on their website, but I would say probably 60-ish days. New York gives you about 4. New York will send you a response and give you 45 days to sign the agreement, register, provide file the returns, and like remit tax. Texas gives you about 60 days after all in all, like 30 days to sign the agreement and another 30 days.
A lot to keep track of if you have multiple states to go back
Yes,
and do this on.
yes. Oh, there is an option that, kind of alleviates some of that, and then for filing the schedules, returns or schedules for sales tax, Texas is the only one that lets you submit schedules. The other two, you have to go online and file the return. So not a lot of fun there. And then three more popular states that are out there that we do a lot of VDA, voluntary disclosure in, Illinois, North Carolina, Washington. You can see, Illinois is a 4-year statute versus 3 in North Carolina. Washington is a unique one, and there are several states that do that will say 3 or 4 years plus the current year. So you kind of want to do it earlier in the year if that's the case. So, if we were doing a voluntary disclosure in Washington, we would probably do January, February of 2023, and then go 22, 21, 20, 19. Incomplete years. Again, with these guys too, Illinois, they have an application form that you can mail or email, however you so choose. North Carolina says you got to mail our application form. And then Washington is a high-tech state, everything's online there. But there, like in Washington, you cannot disclose, you cannot be anonymous. You have to provide your ID. Here, you're a little bit more, North Carolina, Washington allow you to submit schedules as opposed to filing returns, which is nice to do. So, again, I just wanted to provide an example in some of the bigger states that are out there. States that if you're selling into the U.S. from Canada, or you're, a manufacturer, retailer, these are states you're going to have issues with, right? And what I should have put, I didn't put the economic nexus thresholds on here.
Yeah, we can send those to everybody.
Yeah, but Illinois, North Carolina, Washington, it's all 100 grand anyway, and the others are all 5. The other 3 were 500 grand. So, but yeah, I mean, there's a lot to keep track of when it comes to this. So, and then every state offers voluntary disclosure. I mean, you can just Google state tax voluntary disclosure, and you're going to get, everyone's going to pop up, with links to their website. And their websites, when it comes to this, are pretty detailed. they'll provide you with, here are your benefits, here's what we expect, look back period, this and that, here's the process laid out of what you need to do, and then, link to the application if it's something online, addresses, phone numbers for contacts. Again, like you can see from those two slides before, the requirements vary. And the other thing I want to mention right here too, because I've kind of alluded to this here, is you need to consider different tax types. So if you send people into a state to provide repair and maintenance services, you're going to create physical presence. You're going to have nexus for sales tax, and you're going to have nexus for an income tax or gross receipts tax, whatever that state imposes. You might have some withholding tax liability too, who knows? You can't just be like, I'm going to go do voluntary disclosure for sales tax and ignore the other two. I mean, I guess we can. You can do whatever you want, but I wouldn't do it. I mean, you have one crack at it. You do voluntary disclosure for sales tax, most of their terms and conditions say, you better do it for everything else you need to do it for, because you get this one chance at it. So you don't want to ignore other taxes. I mean, you're probably saying, great, not only am I coming out of pocket for the sales tax, now I got to pay an income tax return too. But yeah, you do, unfortunately, but that's because you're doing business there. I mean, what are you going to do? I mean, would you rather have a limited look back period, pay a reduced amount of penalties, maybe get some interest break by doing the sales tax and income tax at one time, or the state coming back 2 years later after they realize you're filing sales tax but you've never remitted an income tax return, and then saying, oh, well, we're auditing you for income tax 6 years back. I mean, it's best to take care of it all at one time. And then also, it's good to know there's localities. Some cities actually have their own VDA programs. Chicago imposes 8 million different taxes. Denver has their own for sales and use tax because it's a home rule city in Colorado. New York City has obviously their own income tax. Philadelphia has a gross receipts tax. Seattle, San Francisco. So a lot of these bigger cities that impose taxes like that also have voluntary disclosure programs that you might want to consider if you're doing business there and have potential liability. One other consideration, we talked about this voluntary disclosure and you have to go to each state. There is an option, kind of, to deal with one organization and handle multiple states at one time. The Multi-State Tax Commission is out there. The MTC was created years ago by the states as a mechanism for them to get together and consolidate issues and their support, over tax matters, state tax matters. Back when it was formed, it was over PL 86272, the income tax law passed by Congress that kind of restricted state income tax imposition. So they got together and formed the MTC to kind of come up with common definitions and terms and whatnot, to kind of consolidate their power into one organization. They have what they call the Multi-State Voluntary Disclosure Program, the MVDP. And it provides a way for taxpayers who have liability in multiple states to negotiate settlements, negotiate a voluntary disclosure agreement using a uniform procedure coordinated by MTC's National Nexus Program. So they have folks who handle voluntary disclosure and the MTC who will work with you and the different states you have to do VDAs in. 38 states plus District of Columbia participate in this. I put a link here to their program. You're saying, oh, Tom, sounds good. I can deal with this MPC. Yes and no. You know, in my experience, I've only done it once or twice, and I feel like they're like a middleman sometimes. It's just in the way because they'll draft up a voluntary disclosure agreement based on your facts and circumstances. Send it to you, you approve it. Send it to the state, and well, they may suggest if you said came up with some like crazy terms like I want to pay 1 year of tax back when the state's look back period is 3, they might say, yeah, the state's not going to go for that. But they're going to send your terms to the state, and the state's either going to go yay or nay. And if the state says nay, they're going to come back with their own terms, and then you're just kind of shuffling paper through the MTC. I don't really find any benefit in that, maybe because this is what I do. I could see maybe if you were handling this on your own, without representation, and I'm not like saying, hey, you got to use representation. You got to use somebody, an accountant, a CPA, consultant, an attorney. But honestly, when it comes to these voluntary disclosures, it's a really good idea too. Because there are so many details and nuances in this tax law and in this process. You want to make sure you're doing everything right in your company. I don't know. Again, they have most states that are there. I don't see the benefit. If they do an amnesty or something, it might be worthwhile. But other than that, I'm not a huge fan of these guys in general, because they're not here for the taxpayer, they're here for the state. So, always remember that the MPC is not your friend. And then the last thing I want to talk about is amnesty. Some states from time to time will do an amnesty program where taxpayers with prior liabilities can come forward, come into compliance. They're typically adopted by state legislation as part of the budget process annually. It's typically like a 6-month, 3-month, 9-month maybe program where you have an opportunity to come clean, on the tax that you owe. The nice thing about amnesty, I guess, is if you're registered in a state and you have an audit ongoing, or if you have another issue that's maybe unresolved, you can usually take advantage of amnesty to lower some interest or penalties. A lot of times with amnesty programs, they will provide a complete waiver of interest and penalties. They just want to get their tax in. You got to be careful with these things, though. You got to watch the time frame. You got to watch what tax types, because they sometimes don't include all the tax types. And even with voluntary disclosure most of the time lets you file for whatever taxes are out there. You got to watch, though, if it's alcohol, cigarette, firearm related type taxes. Those typically may not, motor fuel, those may not be covered. The state does not like messing around on that stuff. So you got to watch when it comes to that. But these amnesty programs will be like, they kind of get you. Maybe they'll say the amnesty runs from July 1st to December 31st of 2023, but it only includes taxes up until the end of 2022. So it's like, okay, well, what about these other 6 months? That's not included in the amnesty. So you're going to get hit for penalties and interest if it's sales tax, because you're going to have to just file those at that point. So gotta watch them. Fortunately, unfortunately, there's no amnesty programs right now. There wasn't any last year either in 2022. They've been really infrequent lately. I think states are kind of, coffers are kind of filled up, with all that federal COVID money and American Rescue Plan money and Infrastructure Act money that, they're not out there looking to get any more in right now. They're not making a big deal about any amnesties, but we typically, if there's an amnesty program, we'll put out a notice or advisory on our website about it, to let people know it might be a good idea to take advantage of. So I think, Carolyn, that's all I got. I'm sure I confused everybody over the last 45 minutes. If anyone has questions, happy to spend a few minutes here answering questions. Again, I think my contact information has been provided in the beginning here. Feel free to email me. But I mean, I'm happy to talk to you. If you want to run a few things by me, see if there's an issue. I'm not going to charge you for that. I'm not going to bill you for that. Hopefully we can work together on something then, help you out, get through this process. Do we have any questions, Carolyn?
Yeah, Margaret has a question. For states that have home rule, like Colorado, where you need to remit specifically to different cities in the state, how does it work? So I'm assuming that's similar to your comment about Chicago and a couple other cities.
Well, it depends. I mean, when it comes to home rule, you're talking for the benefit of everybody. Home rule states are states that allow their localities, like cities and counties, to administer and collect their own sales tax. So that's Alabama, that's Louisiana, kind of used to be Arizona, and it's still Colorado for the most part. Alaska's home rule too, but Alaska doesn't have a statewide sales tax. Their localities just have their own. For Colorado, you would obviously, if you did a voluntary disclosure with the state of Colorado, you would take care of Colorado itself and then any of the state administered localities, counties and cities that report there. Colorado has this new system called SUTS, S-U-T-S, that they just rolled out last year. I don't know what their voluntary disclosure would be for that, but you would typically have to go back to a city like Denver, in Colorado, that is a home rule city, and do a separate VDA with that. Because I know they have their own terms and conditions. We've actually done it in the past. Alabama, Louisiana, if you're truly an out-of-state seller, both of those states have mechanisms now. Alabama with the simplified seller's use tax, Louisiana with their out-of-state seller, I forgot what it's called, remote seller or something, where you don't really necessarily have to worry about the localities anymore. You pay one rate for the whole state and they figure out how to divvy the monies up. So that's kind of going away, hopefully, for those two. But Colorado is still a problem. Well, you have to go directly to them or one of the other big cities there that do their own.
Okay, Margaret, hopefully we answered that for you. If not, let us know. Richard also has a question. Generally, if you are just over the limit, should you consider doing the VPA?
Well, I guess my question would be, so I'm assuming, Richard, like you're saying, if you're over the economic nexus threshold, so if you were just over the threshold based on your calendar year 2022 sales. Let's say you had $110,000 in sales in Pennsylvania in 2022, or 101,000, you wouldn't have to go back and do a VDA for 2022. You would just register prospectively, January 1st or whatever, and start collecting tax then. If it's March, April, and you should have been registered 2 or 3 months ago, I don't know. I don't think it's probably worth doing a voluntary disclosure. What I would maybe do is just try my luck and register April 1st, or register back January 1st. You're going to get notices that, you didn't file returns. If you're quarterly, you might not, but, and then you might pay some interest, pay some penalties. Might be able to negotiate something on the phone with the state, but it's probably not worth doing a VDA for a couple of months. Some states actually have limits too, like, it's got to be at least $1,000, $500, whatever, or it's like, just don't bother.
Okay. that is it for the questions. We want to thank
Nobody
everybody.
else?
Well, you were so good. You had such great examples for us today. As people, if you do have a question, we'll hang on. You can put it in here. I do want to thank everybody for joining us today. As I said, you will get a webinar survey from us when this ends. Again, if you could give us some feedback, let us know if you have additional questions for our experts, anything like that, or run a self-appointment, include that in the survey. Our next webinar will be March 28th. We're switching topics. We're going to be talking about cybersecurity challenges when buying or selling a business. It is going to be a panel discussion, so we have a couple different experts on that one. But if you want to join us, that will be March 28th. And otherwise, we are going to, we do have one more. Diane has a question here. Are gross sales based on bill to or ship to, or does it differ by state?
Most of the time, it's gonna be shipped to. Yeah, it's billed to, I mean, you can be billing to a corporate headquarters in Ohio, but the product's actually being shipped to 10 different states. So you wanna know where the sales, where the tangible personal property was shipped. Because for the most part, sales tax is a destination tax. It's due based on destination of product.
Makes sense, especially with the big corporate ones.
Yeah, we run into that a lot. I mean, most companies are able to tell you the sales by state, even though it's billed to, but sometimes they can't. That can be a real problem, not only for sales tax, but also for income taxes as well.
Great. Thank you, everybody. Thank you for joining us today. And again, let us know if you want to talk with Tom directly on your specific questions. Have a good afternoon, everyone.
Thanks, everyone.